All right, everybody, it is Wednesday, 9 o'clock. Leon and I are coming to you from Investing Education Academy. For those of you listening to the podcast, the comments have come in. I get it. When I say Leon and I, who is I? So the I is Brent Simpson. Kind of remember that the podcast people can't see me. But with that being said, I want to thank everybody for being with us today. The stock market has been all over the place last year, which means many of us have been all over the place emotionally. So we're going to talk about it today. Leon's going to tell you why we're talking about it while I do some housekeeping.
Yep. So inside IEA, the IEA platform, gotten a lot of questions on what to do now, right? Because over the last few weeks, last year, like Brent and I have said from all last year, we were saying last year was an anomaly.
Hold on, Leon. I normally don't do this, but how dare you all send us a message like that?
Explain for the listeners what that is.
Yes. For everybody listening to the podcast and not watching us, who you can't see us, we received a message of Mickey Mouse tapping his toe, asking why we were several minutes late. So yes, I just had to show that. That was quite funny. Hey, life happens for us too. We're doing our best.
Right.
Okay, so let me get back to my housekeeping. Leon's going to tell you why we chose the topic.
So it's IEA. We've getting a lot of questions on what do you do now. And like Brent and I said from jump, last year, 2020 was an anomaly in that the market was up huge. Some stocks were up over 100%. We've always said, look, don't expect it every year. The market on average does 10%. Expect that thereabout. So this year, year hasn't, people aren't seeing 100% returns in their stocks. And some people are like, hey, what's going on? And the last 2 weeks, we've had a lot of volatility. The market, tech stocks got decimated last week. Some are down anywhere from 20 to over 50%. I think it's a good thing personally, because I think the market needed, at least tech stocks needed some sort of correction, some sort of a pullback. And I've been buying into this pullback for myself. So a lot of newbies inside of IEA would say, hey, like, what do I do now? I'm a little nervous, with all these SPACs and all these new IPOs, what do you do, right? So, our perspective at IEA is like, we're always saying all about the long term, all about, long term, never think short term, think long term. And while that's cool to say, unless you've been in this game a minute and actually experience downdrafts and volatility in the market, and then seeing it coming back, unless you've experienced that yourself. Like some people right now are just seeing drawdowns, right? They're seeing their accounts go red. They're seeing losses in their account. It's kind of freaking some people out. And what we always say is, the market long term, it goes from the bottom left, upper right, in between there are dips and valleys. But that's always easy to, it's kind of easy to say. And we did a segment on this a couple months back where we showed, the stock market on average goes up, right? We went back to the 1800s through last year. Well, a lot of us weren't around the 1800s, right? So sometimes it's kind of irrelevant to us. So today we're going to show a chart that shows something we can all relate to from the late 90s, early 2000s through today. We're going to show how there have been some crazy volatile times in this time period, and how today we're almost at all-time highs. Literally, the S&P 500 right now is 1% off of an all-time high. It may not feel like that because last week was crazy. Tech stocks took a hit, took a battering, but the market is still only 1% off all-time high. So we're going to show you that in a minute.
Yeah, and for a lot of you all who are new to the market, and you're thinking, you know what, I don't care. I'm not riding this wave. I'm out. When you get out, if you miss 10 of the fastest growing days in the market, it's the equivalent to missing almost 3 years. So, and this goes back to those of you all who think, I'm gonna time the market. I see what's coming. I'm going to get out because I'm at the top of a drawback, and then I'm gonna get in at the bottom of the drawback when it's coming, coming back up. It's very hard to time either one of those. And those are historical points. Those are rearview mirror investing pieces. Because, if you're looking at it from, historical standpoint, it's like, oh yeah, I knew that was gonna be the bottom. Did you really? No one knows the bottom when they're in it. You don't know how long it's gonna drop. You don't know how precipitously it's going to drop. You don't know how high it's gonna climb back up, or maybe it's an artificial pullback. No one really knows. And that's why we always stress buying quality companies And also, this is why you're a part of the community, because Leon and I did get those phone calls. We did get people inside the platform that were like, the sky's falling, what to do. And I know for a fact there were at least 2 people that more than likely would have sold their portfolio if they didn't talk to us. And because they did, they kept the portfolio, and everything was not going to say fine, because some companies are still depressed. They needed to be. Those companies needed a correction. Valuations are crazy. And so, and then there were other people who just were happy. They've been, following Leon in that space of like, Leon has been giddy to buy. But this is that moment where, do you have your account set up properly? And I'll tell you what I mean by that. Do you have money set aside for times like this? Do you have for those of you all can't buy a full share, do you have an account that allows for fractional shares? These things make investing much easier, much more digestible. And it gives you the opportunity if you're not going all in when there's a pullback like this, maybe you get some fractions of a share. That's the strategy, but it's a strategy based off of, people say, oh, you just happen to win in the market. No, that's where opportunity meets preparation. The opportunity came and you were prepared with the right accounts. And we've been talking to you all. Last year was an anomaly. We're not going to see that this year. It's more than likely we will not see that this year. The market, however, normally is going to outperform real estate. Is going to in the long run, is going to outperform any bank account. Any bank account. If you have a bank account, you're losing. And, normally we don't say things, we try to stay super positive. We're positively telling you that you're going to lose if you have your money in a savings account. And right now, you're not in the market. And we're going to talk about it throughout this live. So I'll pull up the first slide and we can dive into it. And if you have questions, I saw one question already came up. And the question was tech or electric vehicle marketplace. They're kind of the same thing. But I understand the question is, should we be looking towards tech stocks or should we be looking towards electric vehicles? They're kissing cousins. And really the question is, if you're looking between tech, electric vehicles, and or solar, like right now, those are the sectors moving the market. And Leon, if I'm missing anything, just jump in. If you're looking to invest in a depressed, like companies that are slightly had that pullback, more than likely you're going to find those in the EV and tech space. You probably won't find those companies still down that are solar based. I would doubt it. So So the like I was saying, the top performing sectors the last 5-8 years has been technology. It's just the end all be all really in the market. Second and a close second, and then they kind of teeter back and forth between solar and technology. So like for me today, I was active this morning. I increased my position in technology and I increased my position in the solar sector. EV, the main one I'm in is, so I'm in Tesla, XPIV, how do you say it? XPeng? XPeng.
And XPeng and Leap. Those two are small positions. I'm a bigger position in Tesla. But yeah, Brent said they're kissing cousins. Like, I mean, EV is considered the stepchild or cousin of technology. So it's going to kind of move. They get EV companies have the same valuations as technology companies in that they're expected to grow hugely in the future. So a lot of them are volatile. So you want to, kind of size your position accordingly. But I would say do both. Like, why pick? Buy some EV and buy some tech. You can do both.
And Leon, we got a direct question that came in. It said, what are you all buying in this time? And I'll tell you, during the pullback, I went heavy on Tesla, XPeng, Neo, and Snow, Gooder RX. And those were the main 3. Those were the main four or five that I got.
For me, it was, so in technology, so technology is the umbrella, and one of the industries underneath the technology is semiconductors. So I've been really trying to boost my position there. So I've been buying NVIDIA, AMD, Ambarella, and Qualcomm. Those are 3 ones I did this morning. I also been buying, names Facebook, Microsoft. In solar, I bought the TAN, TAN ETF.
Oh yeah.
I also bought I think they're called California Solar, CQSI.
Yes.
I think it's called California Solar, and Enphase. So those are a few that I bought on last week. And like I said, I'm trying to increase my position mainly in semiconductors and solar because I'm way underweight what I should be in those. I was actually really, at one point I was really big in crypto, went a little crazy, and then I had to kind of like reallocate some money and then buy more into the stock market to bring my crypto allocation down some. But yeah, that's what I've been buying.
Yeah, and I know for you, when you said that, I increased my position in Bitcoin Cash, Graph on crypto, and there was a third crypto I bought. I can't remember. I'll put everything I bought last week inside of the platform as a note, so, or a topic. So I'll post it inside the platform for all our members. I'll list everything that I bought, crypto and my stocks that I bought last week.
Yeah, and inside the platform, I actually posted, I think a couple of days ago, I posted my crypto portfolio. So I think I have like 5 or 6 different crypto positions I'm in. So it's all IA members, you can go in there and view that.
Yeah, and I know one of the cryptos I know I had has grown, I think it was like 26% in the since Monday. And I know, Leon, you definitely, you had one that was like 33% yesterday.
So, yeah, one was up, 34% yesterday. Yeah.
That's crazy. So we're way off.
Yeah.
But the point is, you have to understand your emotions in times like this. And, stories really help people understand things. Everyone knows, I talk about it all the time. I have an account that's way overweighted. It's a single stock risk in Tesla. I mean, just point blank, it is. When Tesla went down,
yeah. Hey, I was thinking it. I was like, Brent might be hurt right now because that 25-30% position in Tesla.
Yeah, I was fine. I mean, it's Tesla. I didn't care.
Yeah, I know you don't trust. You know what you're doing. Yeah.
So I bought more when it got to like 5, 6, and I literally had somebody call, and they just got out their position because they had a trigger of 20%, a 20% drop trigger on Tesla, and I told them not to put it on. And they had it sold. Once it sold, they were, what everybody does. Like, should I get back in? Is what wait? How far down will it go? And I think Tesla had just hit like 560. And it might have been 561. And we talked, and I was like, don't wait, just get it. What's the worst that can happen? So that was my only explanation to the person. They were like, that's not good enough. I was like, all right. I was like, so I'm going to increase my position. Tesla closed today at like 680 or something.
Yeah, it was over 700 at one point.
I'm like, man, I know it's not what you want to do normally in a market, but when you understand the company and also the management, it's still not smart. I'm gonna be honest with you. Like, I would never consult somebody on doing it, but you have to know what your risk tolerance is. And Leon said it very eloquently in the beginning. We have cut our teeth on markets like this and you're gonna see on the slide we're about to pull up, for over 20 some years. So, we're 44, and people might think, oh, you guys must just be new to. No, we're not new to the market. And even when we weren't fully invested in the market, we were watching it as if we were. Mm-hmm. And so we have an intimate understanding and knowledge of the behavior of the stock market. And when you understand the behavior, times like last week don't really phase you because, again, I'm reference Leon a lot today. Leon always says this one thing: unless you think the U.S. economy is about to fail, then the stock market's not going anywhere. And that's so true. Some of these companies are too big to fail. I mean, it's true. So we're going to show you some evidence on why we're saying what we're saying. Let me pull up slide 1.
Yeah, so this graph is going to show, so this is showing, so what's on the screen is a chart of going back to right about 1999, 2000 through today. And so this is basically proving with factual information that if you stay the course in the market, historically, history shows the market will come back. So back in 1999, 2000, we had 2 and the reason I chose these dates is because most of us watching this were alive. May not have been in the market, but we remember these times. Going back to the 1800s, it's like that's just really abstract, right? So starting about 1999, we can all kind of relate, right? So 1999, 2000 through 2001, we had two things happen. We had the dot-com bust, and we had 9/11, the terrorist attacks in New York. And the stock market dropped. This is S&P 500. The stock market dropped by 50%, right? 50%. So that was a huge hit. A lot of people lost a lot of money. A lot of people sold out, never came back to the market. They were freaked out by it. You know, the whole terrorist attack, 9/11 thing with the market crashing just freaked a lot of people out. A couple of years later, the market recovered. Then we move into 2008, 2009, where we had, of course, the credit crisis. The real estate market blew up around the world, and the market dropped 53%, which we now call the Great Recession. So within a decade, I mean, this is within 10 years, you had two 50% plus drops in the stock market. You know, people that were new, that just got in the early 2000s and saw that drop, then saw it happen again in 2008. We're like, you know what, this is crap. This thing is rigged. I'm out. And the data actually showed that a lot of people after the Great Recession did not come back. Like the volumes of the stock market was a lot lower, and the amount of shares that were moving back and forth was a lot lower than the early 2000s, because people were just freaked out by these two 9/11 dot-com busts and then Great Recession. And then the market after that, 2009 through 2020, the market was great. You know, the market recovered, reached all-time highs. And then what we all just are still currently living through was COVID. And then the market dropped 35%. Now, through all that, so we think about this, we had a 50% drop, a 53% drop, and a 35% drop, all within, two of those were within 10 years, and then all of those within 20 years. And I say all that to say, as of today, the stock market is 1% off an all-time high. So what does all this mean? Basically, it means that what we're saying is that, yeah, there's trials and tribulations. The market can drop by 50+%. But as Brent said earlier, and what I always say is that the stock market is a bet on the U.S. economy. If you think the U.S. economy is going to go to crap and fall apart and never come back, stock market's not a place for you. If you believe the U.S. economy, as it's always done, and it's the largest economy on the planet, and has been for decades, will return and continue higher and continue that stronger pace in the future, then stock market's where you want to be. And these events show it, right? I mean, you had a terrorist attack. The stock market actually fell apart in the year 2000, 2001. Credit crisis. I mean, everyone really thought the world was coming to an end during the credit crisis. And then, of course, COVID. I mean, we have 500,000 dead, 10 million jobs lost, unemployment got up to 20%, right? All of that said, the market is 1% off all-time highs. Yeah. So what we're always saying is, what Brent always say is, you have to think long-term, right? I mean, and these recoveries didn't happen overnight, right? I mean, if you look at 2000, the market didn't go back to all-time highs till about 2015. Where so if you bought right around 2000 before the market dropped, you didn't get back to even for another 15 years.
Well,
right?
Well, yeah, with that too, is also if you understood sector growth. This is one of those spaces where, this is overall market, yes. But if you understood sector growth, this chart is completely different based off the sector you're in. Because we were in the market in 2000, 99, 97, all of those, we were in the market. And, for me, I'm going to tell you, I owned Qualcomm when the bubble burst, and Qualcomm had just a $356 investment in Qualcomm would have yielded you roughly $32,000 in less than a 2-year period. And that was right before the burst. But even now, we're talking about the dot-com bust, right? If you listen to even what Leon said last week, he's still buying Qualcomm. Like, this is a company that through all of the 50, the 53%, the 35% drops, people are still buying. We're still buying. Educated people in the market are still buying it. And so what does that mean at those moments? It meant it was an extreme discount. Mm-hmm. And if you could have got in and just rolled through it, and this is why, to another piece, we always say you want to invest risk capital. Leon and I never come on and we give you strategies on how to max a credit card. And we know those strategies. We don't talk about them because it's not appropriate for the everyday investor. It is not fiscally responsible of us to give you these strategies that will cause you not only a type of stress that is detrimental to your health, but it can be detrimental to your marriage, to your job. when you start essentially treating the stock market like it's a gambling casino, is when things go wrong. And when these 50, 53%, 35% drop hit, you don't know what to do because you leveraged your house. And that mortgage payment has to be paid. Or, Leon and I talked about buying stocks on margin when we were in our, I think was it on a live or was it in?
No, we were talking about Clubhouse.
Yeah. And so, also anybody who wants to talk with us on Clubhouse, after this, we will be on Clubhouse. But essentially what we're saying is this chart represents the S&P 500, but it doesn't represent specific sectors. So there were sectors that recovered faster than the market, which oftentimes happens. There are certain companies that respond better than the overall market. That oftentimes happens. So when you're in communities where we're not all, just gambling, like, day trading or, trying to get in, get out, trying to time the market, it's better to have time in the market than timing the market because you have no basis. And if you're using your primary funds, when these hit, you have to get out because you're panicked and you need the money for something else. Use risk capital. Don't use money that you necessarily don't need, that you're willing to risk. And don't get in here trying to gamble and find a hot thing because it was in the news. Because a lot of times it's pay to play in the news and you end up on the bad side of the newsprint. So
yeah, so I mean, so everyone watching that can see this chart. I mean, take a picture of it, like commit it to your memory. Just look at it and realize this is history. And these drops are massive. 50% drop, 53% drop, and 35% drop in the stock market over the last 20 years. Two of them within 10 years, and we're 1% off all-time highs. The market, as long as the economy is doing well, the market always recovers. And all these dips are buying opportunities. They're not times to sell. They're not times to run. They are times to buy quality companies. We're not saying buy these speculative SPACs. We're not saying buy penny stocks. We're saying buy the quality companies that we all know and love, Home Depots, Microsofts, Teslas, Pfizer's, things of the world. I mean, it's not wrong with, more riskier companies too, but you still want to have a portfolio mainly of quality companies, dividend paying companies, things like that. And those come back. And that, like Brent said, that was a good point. This is the general market. Some stocks recovered after the .com boom, got to all-time highs within like a year. This data shows that typically markets recover after about a year and a half, 2 years, or I say a bear market. Bear market is considered 20% down. So typically markets will come back out of that bear market after about a year and a half, 2 years. Not saying all-time high.
More than 3.
Yeah. Well, yeah, right. Let's say 3 years.
No,
no
more than 3.
Oh, no more than 3. Yeah, no more than 3. Right. And not saying all-time highs, just saying coming out of a bear market. In other words, they're coming off of a 20% drop and then starting to move up. So this again, we're just trying to let people know when the market is dropped, it's no time to sell unless you have, a valid reason to sell. If you're selling out of panic, that's no time to sell. If the fundamentals of companies have not changed, no time to sell. It's actually a time to buy more. And that's what I've been doing the last 2 weeks as a market's been very volatile. But again, this just shows you that any dip in the market, especially big dips, are huge buying opportunities.
And what did Warren Buffett say? When people are being greedy, be cautious. When people are being cautious, be greedy. Mm-hmm. And it's like, it holds true for a lot of the people who become mega wealthy in stock market dips. So for us, everybody in IEA, the moral of this story is please don't panic from last week. Stay the course. If you're in Investing Education Academy's community, you already know we're putting listings on other stuff we're investing in up on a regular basis, and we have our write-ups, and our intern is doing her job, and she's in there engaging. Leon has told me. So there's a lot of good stuff coming. We're still ramping up our offerings to the community. So with that being said, we owe you all some picks. You want to go first, Leon?
No, you go ahead.
Okay, so I'm gonna go ahead and pick a company that just went public today. So I'm gonna pick Roblox. And the reason I picked it was because it was an easy choice. So
I was about to say super easy.
Yeah, oh my gosh, it was beyond easy. It was the best thing. I was like, yeah, that's what I'm gonna do. Let me pull it up. Give me 1 second. So I chose it because number one, Roblox is like one of the most addictive and fast growing game system for kids. Additionally to that, I do think there are going to be some pullback from it from today's highs over the next like 3 weeks. But I'm looking at this as a long-term play, like we often say, buy and hold strategy. If you are looking, oh, I'm not doing a screen share. If you're looking to hold it at a lower price, I think there would be some pullback. It's a highly popular stock. And, one of the reality is it's overvalued, yes. But as Leon and I sometimes say, part of the stock market is a popularity contest. Now, should it be that? No. Is it that? Yes. Will Roblox stay at this number, $670? You might see it run for maybe $10 more. I think you will see a pullback as people take some of the profit. And also, I don't know what the lockout period is for Roblox. And let me explain what a lockout period is for all of you all.
No. There is none. It was a direct listing, so no lockout period.
Yeah, no lockout period. Perfect. So let me explain then direct listings. Direct listings mean that the company issues direct listing means the company issues shares to bring liquidity to the stock, and they didn't go through traditional underwriting, and that also means that there's no lockout period. Normally, what means the employees can't liquidate their investments. Now, let's talk about what a direct listing, why some companies do it. I don't know if Roblox did it for this reason. It often is done to bring liquidity to the stock, which is what we just talked about in our one of our IEA group members discussions. These companies have stocks that are tied up in with their employees in stock option plans. Their employees have no way of liquidating those shares. So essentially they're sitting on paper money. Like they can't do anything with it. They can't cash it. It's just, they know they have stock options. When in the time and space they can cash them out, no one knows. When companies do direct listings, it's often to give them what's called a liquidity event, meaning they can go into the stock market and sell those shares and become millionaires or, do pretty well overnight. But what that really means from a strategy standpoint is Roblox doesn't have to give them more money. And some of those, when some companies hold on to their shares and don't go public for an extended period of time, they start to get internal pressure that people want raises. There's no liquidity event for them. So they're living only off their salary. And for startups, it's hard for them to really pay those people a salary. So they do direct listing. So I'm not saying they did it for that reason, but one of the things is we want to educate you all on these topics and why they happen. And that's something you probably wouldn't have known otherwise. Oh, yep. So Roblox ticker symbol is RBLX. It's currently trading at $69.50. And this is just insane. The company, when they IPO, they have over a $35 billion market cap. And they just IPO. So to put that into perspective, GE's market cap is $115 billion. They are at almost closer to 40 billion, and they just IPO today. That's just it's a different day and age.
Yep. But I mean, they're considered a platform company, a tech company, a growth company. So that these evaluations they get, will it drop? Who knows? Everything's a risk. But one thing I like about Roblox, they actually have their own cryptocurrency. It's called Robux, and I just bought my nephew $25,000 Robux gift card for his birthday recently. So I actually want to look that up and see if it's a cryptocurrency that can be bought and traded. So I need to check on that. But yeah, I mean, I like Roblox. I actually think I'm gonna buy some maybe tomorrow, just a small position, just to dip my toe in.
Yeah, and full disclosure, I bought it today on the at the IPO.
Oh yeah, okay. So my pick is Pinterest. Ticker symbol PINS. Today it closed at $68.97. And was up 2.2%. Real quick, when I was just doing my research, I realized that today Pinterest closed up 2.2% today. I know we always harp on this, but the average interest rate on in a savings account is 0.05%. So what Pinterest did today at going up was up 2.2%, was 3,900% more return than you would get a year's worth of return in a savings account. So I just want to make that point again about let's please get our investment dollars out of savings accounts. So some of Pinterest's stats is that they're growing revenues the last 2 to 3 years. I think that's 3 years, 53% on average per year. Now they're not yet profitable, so there's no profit number to report yet. They're quote unquote growth company, and it's a tech company recently public over the last year or two, and so a lot of their money they're just applying back into the business to grow it. So they have over 400 million active monthly users. They are to show that they're not necessarily just a U.S. company. The last earnings report, they said international revenue international revenue in the fourth quarter doubled in their most recent fourth quarter. And then in the first quarter of this year, they're projecting revenue to grow by more than 70%. So international revenue doubled in the fourth quarter. And in the first quarter, they're expecting the company-wide revenue to grow by more than 70%. So Pinterest is a classic tech growth company, not yet profitable, but a growing revenue at on average the last 3 years at over 50%. So that's my Pinterest.
And Pinterest, I know at one point in time they hold the title for being like the third largest search engine on the internet, but I don't know. That was like 3 years ago. I don't know if they still hold that title. But Pinterest is hugely underutilized as a SEO play for people who have goods and services to sell. But that's a whole nother thing. Yeah, good pick, Leon. I like that one.
All right, cool.
I wouldn't even thought to look at Pinterest.
I wouldn't have either until Ashley mentioned it to us, and Ashley is works with Brent and I, and I just was like, to me, Pinterest is just this thing that you post pic. Like I just didn't get it, and I actually, truthfully, I still don't get it. When I looked at their numbers, I was like, oh, okay, this is a legit real business. So now I'm like, okay, I'm all about Pinterest.
No, yeah, but, it's a lot of business owners getting a lot of revenue from Pinterest.
Yeah, I was surprised. I'm like, it's like a message board you post pictures to. I don't get it, but I get the numbers. So
no. It's a big advertisement. I give it to you. Like Pinterest essentially is a huge for sale platform that isn't designed like a Craigslist, nor is it designed like a eBay. But now people who are becoming more savvy are not only putting their pictures of finished products and things up, but they're the beginning of most businesses' click funnels. So it's a top of the funnel platform. And as people go and engage with their pictures, they're clicking, which takes them to the top of the funnel. And then they come down, and that's where the sales cycle starts. And it's helping people generate massive amounts of money because it's very quick. It's easy for somebody to identify. A lot of fashion is sold on Pinterest because, of course, it's visual. And again, for business owners, I think it's a platform some know about, but not enough. And it's growing because even I've taken some business ventures to Pinterest and done pretty well with them.
Yeah, I mean, like I said, the numbers don't lie. So I'm not a Pinterest hater anymore.
Well, look, everybody, we want to thank you for being with us. If you're watching, we are going over to Clubhouse to hang out for a little while. If you're interested in joining Investing Education Academy, you can now find us. Oh, everybody, go to investingeducationacademy.com. Check out the new website. So we told you all the new website was coming. We're constantly working on improving. The website is up, investingeducationacademy.com. And you can also go to ieanow.com, and it will take you to the website as well. So some things are coming, some new stuff. So it's fun times in the city. If you want to join, there's a link in the middle of the platform, in the middle of our website, where you can actually choose your membership platform and become a member of the Investing Education Academy and start learning some of the stuff we put public, but more so the stuff that is still behind the paywall. So catch us over at Clubhouse. Look for Leon Noble or Brent Simpson. We thank all of you all for being with us. We hope this information helps you get through times like this, because if you don't have anybody available to talk to, sometimes you panic and you make a rash decision, and you wish you wouldn't have done it after it was over, but you had nobody to talk to. So please join IEA. And Leon, anything before we go?
No, that was it. That was just we'll be able to over on Clubhouse in about 10 minutes or so.
Yep. See you there.